Good day, guys. Thanks for joining me again. We'll be doing a seminar this week on the this holiday structure, which basically will be ending in a couple of weeks' time on the 10th of May. It's offshore. We think it's quite good, and we'll be starting in just about a minute. And going through the details of it and why we chose it and why we chose the particular makeup of the product. So, okay, as we start, let's just go through Rand Swiss and who we are and what we do, etc. Wait a second. Okay. As usual, we start off with our awards. As you can see, they are numerous. Just for the last years. So we got the best broker again. This is I think it's the 4 out of the last 5 years we've been awarded the top broker in South Africa. Not only the top broker for last year and this year, we're also the most improved broker. So, our gap has increased. We also have full service brokers, lump sum investor broker, relationship manager, etc. So we've done reasonably well in the top broker awards again. As you guys know, we value client support. We are really keen on that in terms of the products we offer. Class leading, costs are low, and the responsible and value for money is also quite high. And let's just start off the seminar with a little quote from Phil McGraw, Dr. Phil. Don't wait until you're in a crisis to come up with a crisis plan. And that's an important thing to think about. We are in a situation right now where it's pretty obvious that the world is in a very uncertain time. And you need to prepare for that in advance. Trying to do it after things have started to fall or after we start to see a bit of a downturn coming through is probably the wrong time to do it. If you see things coming, you see things turning badly, make sure that you have yourself prepared in advance. Okay. In terms of this particular structure here, wait a second. This is what you should look at if you are thinking this might be good for you. First of all, the minimum amount to invest here is $20,000. Okay, so you must be willing to invest at least that much if you're looking at the structure. And you also obviously want to be invested in dollars because this is going to be a dollar program with investment as well as, give me a second here, with investment as well as returns in dollars. You would like returns that are in excess of developed market interest rates. You believe that the worst performing indices will rise above the current level in the next 5 years. You're looking for an investment that offers some capital protection, but not complete capital protection. So you think that there's going to be uncertainty, but it's not going to be a complete collapse. You do not need regular dividends or income. You're able to commit your money for the full period, and you're comfortable with the credit risk of the offshore bank that we are going to give you. Okay, let's talk about a global overview and why I think that we are in a situation right now that could be really dangerous for the next few years. So let's start off with just some of the clear dangers at the moment. For instance, Russia. The Russia-Ukraine war seems to be going against Ukraine and in favor of Russia. This is bad for the following reasons, not just if you're thinking of Russia versus Ukraine, and Ukraine is the good guy and Russia is the bad guy, etc., but from more of a realist kind of standpoint. Europe and America have backed Ukraine. If Russia wins, that really damages the credibility of that alliance, that NATO alliance. The danger here is that what happens down the line is that other parties, that we'll talk about Iran and China later on, see this weakness as weakness that can be exploited. That means, hey, these guys went up against Russia, they couldn't beat Russia. If we add on or jump on the ship here, they probably aren't going to be able to beat us as well. For the last 80 years, okay, just about, the world has been reasonably peaceful. Why? Because there's been almost a set world order. The US at the top and everyone else at below them. No one wants to mess with the US because their economy is large, but their military is also very large. So if they basically go into Iraq or they go into, whatever they go into, like Afghanistan and so on, they basically are able to, step in and no other parties, other major powers are willing to intervene, That may be unfair, may be fair, forget about that. But what the benefit of having a single undisputed leader is that there's peace. Because unless the war is started by that single undisputed leader, nobody else wants to start a war because they don't want to mess with this undisputed leader. They're too big to mess around with. However, if that leader starts to look weak, then that top spot can be up for grabs. And when that top spot is up for grabs is historically when we find the greatest amount of uncertainty, because people think we could be the guys on top, okay? And so if Russia is able to defeat Ukraine, number one, they move closer to the West, they move closer to Europe. The Americans look weak. The American-European alliance, which is effectively what we're talking about, the number one combination, that alliance looks very weak. And that might encourage China, Iran, and so on to basically do something as well to go against that alliance. So if Russia is winning, what's going to be happening? We're going to have the Europeans and the Americans trying to step up and support the Ukrainians. You already had in the last week or so $61 billion more going towards Ukraine. That's probably going to last for less than a year before another allotment is given if the Ukrainians stand up for the next year or so. And that's going to turn into a longer-term, funding of the Ukrainians. Now, the problem here is that it's probably going to mean that the Ukrainians don't win, but they don't collapse, which is maybe a very bad long-term situation, because what that translates into is effectively we're going to be in a situation where the amount of danger in the world carries on increasing the longer this war carries on increasing. We've seen repeatedly, as wars carry on, things that were once unacceptable become more acceptable and then commonplace. Things that were unacceptable, for instance, like Americans being or Europeans being, involved directly in the war, might become acceptable. The French are already talking about putting 20,000 troops into Ukraine. That's not going to be a lot of troops compared to the Russians or the Ukrainians, but it's French troops, they're NATO troops. It's a different story when the NATO troops are involved. Then if it's NATO troops, maybe there may be American troops involved. There's also certain classes of weaponry that the Americans and the Europeans have not given the Ukrainians, things that could hit inside Russia, okay? They've been largely giving them things that defend against Russian attack, maybe attack Russians in Ukraine, but they don't have many weapons that's been sent over that can attack Russians in Russia. That might change. If the Russians suddenly get attacked in Russia, they might be more willing to do things that they weren't willing to do before, like really attack Ukrainian cities. The Russians, obviously have done bad things in the Ukraine, but they have not used their biggest weaponry. They have not used, forget about nuclear weapons, they've got weapons above what they have right now that they've not used. Okay, and speaking of nuclear weapons, they might decide down the line if they're in much of a threat because some of the Ukrainians are attacking Moscow, for instance, that they might want to use nuclear weapons. Like, see how as this thing goes on, it becomes more and more dangerous. So the Russia situation is a big problem, okay? Next, Iran. Now, over the last weekend, we saw Israel attack Iran after Iran attacked Israel. Right now, it seems to be reasonably calm. But Iran remains, firstly on the side of Russia, in this Russia-Ukrainian war, so might be dragged in further from that point of view, and firmly against the Israeli regime in at the moment, and supporting parties such as the Houthis in Yemen, the Hezbollah in Lebanon, supporting Hamas at the moment, whatever is left of Hamas in Gaza. This combination puts Iran firmly at loggerheads with the US and the West. At the same time, as time goes by, again, this gets worse because Iran, a few years ago was not that far away from a nuclear weapon. And quite frankly, without severe sanctions and without monitoring, etc., I don't know how long it remains that Iran has no nuclear weapon. Then a nuclear-powered or nuclear-armed Iran, what does that mean? That probably means a nuclear-armed Saudi Arabia. That probably means a nuclear-armed Egypt. It means a nuclear-armed Middle East. Okay, right now, the only power in the Middle East that has nukes is Israel. And maybe you can say Turkey because they're part of NATO. But you progress down from that with a nuclear-armed Iran, you're going to get a nuclear-armed Saudi Arabia. You will get a nuclear-armed Egypt. And if Egypt's nuclear has nukes, then is Algeria. Then we're talking about Sudan probably trying if they can afford it. We are talking about possibly Nigeria down the line, because again it's the African continent, and if they're Morocco and for instance Algeria get nukes, Nigeria might want to be looking at that as well. And suddenly you're talking about a very dangerous world that we are living in. Already on the other side, to like the east of Iran, all of them are nuclear armed. Pakistan, India, China, all have nukes. But a nuclear armed Iran might move that even more towards the west as well. Then China. China at the moment is looking towards Taiwan, wants to get basically Taiwan back into the fold as they see it. They haven't been out of the fold for like 80 years since the end of World War II, but they want to bring Taiwan back into the fold because Taiwan, in Chinese, belongs to China. That means that the Chinese view them as almost like a breakaway province. Now, Taiwan is important in ways that Ukraine is not. Taiwan is the source of much of the world's, chip production. The Taiwanese company called TSMC has become the undisputed world leader in manufacturing the best end chips in the world. Yes, there's been exposure or attempts to get production happening in Japan, production happening in Texas, and so on. It remains to be seen just how much of that technology can be transferred and how easily can be transferred. I mean, even in the Texas plant, the only way that's operating is when half the staff is basically Taiwanese. Now, if the Chinese do attack Taiwan, that'll probably bring in Japan into play. That'll probably bring in South Korea into play, Australia, India. It's a very, very dangerous thing to be. Obviously, the US will be involved as well. And suddenly we have, again, if Taiwan is invaded, they had no nukes. Maybe you want to have nukes in that region. Maybe the South Koreans want to have nuclear weapons. Maybe the Japanese want to have nuclear weapons. That's what the whole thing kind of like boils down to at the end. And that, again, becomes a much more dangerous thing. Then we look at South Africa. Of course, we have elections coming about in the next, month or so. As I speak to you, it's going to be happening in literally a month's time. We are going to a period where the ANC is likely to drop below 50%, and by some recent polls, below 40%. We've seen the rise of new parties like the MK party of Jacob Zuma. We've seen the strengthening of parties like the DA, which looks to be going towards the mid 20%. EFF remains like low teens. And obviously the smaller parties out there. That's a very chaotic picture with a 37% largest party and a whole bunch of parties that could team up to get over the 50% mark. In that scenario, we would see likely a very, very unstable political alliance, a political coalition being created to govern the country. And that's not a good way to go forward. And then there are black swans. I mean, just this year alone, we're going to be in a situation in which about half the world's population is going to be voting for new governments. We're talking about places like the US, we're talking about the UK, we're talking about India, lots of places, lots of votes. And South Africa as well, can include that there. And the outcomes of these elections could be quite significant going forward. And that's one of the black swans we're talking about. The other black swans out there, we are entering an era of AI development that has been, spectacularly successful so far. Who knows how long and how much it can continue. And then we're talking about, of course, just a few years ago, we had like a thing like COVID come about. Who knows what the next kind of, total black swan is, but we don't even know what that thing looks like right now. So the time or the era we're in is an era of, I would think, almost unprecedented crisis, at least in our lifetimes. I mean, this obviously doesn't compare to the 1930s or something, but I mean, it's certainly a more uncertain time than we saw in the 1990s or the early 2000s or the 2010s. So for the last 30 years or so, you can say this is one of the more unstable periods in global times, and therefore, your investments obviously are, in question. I haven't even talked about the fact that we see inflation still quite high. I think we just had some numbers from the US today where GDP is basically coming in lower than expected. How does it all figure into your investment plan going forward? Now, why we chose this particular product is threefold. Firstly, we wanted global diversification. We wanted to have, exposure around the world. And the reason that we are exposed to the US, Europe, and the Nikkei is because, firstly, that combination gives us a higher return, number one. And number two, that we think they're reasonably highly correlated. These are big markets, right? Big indices, sorry. The NASDAQ is like, not as big as the S&P, but it's big. Euro Stoxx 50 is like the biggest in Europe, and the Nikkei, of course, the biggest in Japan. We wanted to have this basically exposure because we think the combination of these three together gives us a return without increasing our risk too greatly. The next thing is we wanted to be in the US dollar. Why? Well, the Japanese yen, they have issues with regards to their currency, but in ways that don't really affect the Nikkei too negatively. Europe as well, issues with regards to the euro. Who knows what the position of the euro is a few years down the line. But with regards to the effect on the European companies itself, I don't think it's too bad. The US dollar remains what I think is the most, reliable currency in the world by far. Yes, there are issues longer term about debt and so on, but it's not going to affect things in the next 5 years or so. And finally, in the currently, uncertain period that we're in, having an autocall gives us the added advantage of being protected against a once-off event near the end of the lifespan of the structure. If you think back when COVID, I had a structure that expired during COVID for a client. And had this client had the structure expire 2 months earlier or a month later, they would have gotten an 80+% return in rands. But because it expired on the particular month it expired on, which was just after we started the lockdowns and the market had crashed, unfortunately, they just got their money back. They didn't lose money, they got the money returned. But unfortunately, they were just unlucky enough to have it expire at the time in which it did, which was in the, say, 2 or 3 month period. That was the only 2 or 3 month period in the entire 5 years where they would have been, negatively affected. So when you have an autocall, the advantage of an autocall is that there's multiple call dates. In this particular case, there's 9 call dates. So you get a semi-annual call every year, so twice a year, starting at the end of year 1. So you must have the first one in 6 months, but 12 months, 18 months, 24 months, 30 months, and so on. Every of those 6 months, you get a chance to exit. That severely reduces the chance that any once-off event can affect you. Let's just say there's a once-off event. COVID-2 happens at the end of the next year. Market falls 40%, massively out of the money. If you follow the same pattern as the first COVID, you'd be out basically in a year and a half's time after that. You would have gotten 2 years, 2.5 years worth of returns at 12% a year, and you would have exited. Okay, so even with a very massive event like COVID, okay, the structure would basically have gone through. And I don't think that you want to be in a situation where you are at the mercy of an individual event that might just happen to occur at the time at which your particular product is going to be expiring. An autocall in this environment just has a better payoff risk profile than an investment with a single fixed closing date. Now, here are the investment terms. So this index is exposed to the NASDAQ 100, the Nikkei 225, and the Euro Stoxx 50 index. These are the largest companies in the US, some of the largest companies in the US, Japan, and Europe. Now, we're not tracking the index directly. That's important because, like I said, I don't trust the yen. I don't trust the euro as much as I trust the dollar. We're tracking the nominal value. So let's just say the yen weakens dramatically. That will actually help the Nikkei because in pure number terms, the Nikkei would go up because the yen is weaker. And that's number terms, that's what matters here. The same thing with the euro. The euro weakened to where it was a couple of years ago versus the dollar. We would see a significant strengthening of the European companies because they suddenly earn a lot more money in euro terms than they were in the past, and that makes them become more valuable. So we are looking at just the numbers, not the actual underlying valuations of these companies, because if you look at the underlying valuations, you've got to convert the currency. We don't convert the currency. The investment return. If the worst performing of these indices is positive for any of the 9 times over the next 5 years, you will receive an annual interest simple interest return of at least 12% of the input for the period invested. Okay, or the period participated. What does this mean? This thing gives you a 12% dollar return. Very high. A 10-year yield on the US 10-year at the moment Treasury is about 4.5%. This is significantly higher than that. The US inflation rate right now, by most measures, is under 4%. So this is an 8% plus real return, which is a very good real return. Now, you have 9 chances here. 9 chances over the next 5 years for when all these 3 things have to be basically flat to positive. The chance of that happening is significantly higher than basically hoping that at the end of a period, one of these things are positive. And that is why we basically chose this model. The next thing is the 12%. 12% is important. Look at the S&P 500 return historically. It's about 10%. And if you look at like about the 1950s till now, 12% is 2% higher than that. That's quite a nice little premium to what the S&P has done historically. And this is from an S&P right now that's basically at all-time highs. Partial capital protection maturity. If this thing does not fall by 35% or more, or this worst performing does not fall by 35% or more, you'll receive 100% of your capital back in dollars. If it falls more than that, then you will receive the percentage fall of the worst performing index. Now, 35% fall sounds, scary, but if you look at a 5-year period, really do you have such an economic crisis that after 5 years, you'd find one of these indices negative? It would be, a very rare occurrence. And by giving us the protection that matters, protection that covers us in most of the time, as opposed to protection that covers us all the time, we're able to get a better return than we otherwise would. Yes, we could have gone for 100% protection, but that doesn't make sense because it's a very rare event. And for that rare event, we're going to lose a lot of return. So we've balanced return versus risk. We've taken slightly more risk, but still you're protected unless there's a 35% fall in the worst performing index. That is a pretty good level of protection. And for that, we're able to get significantly above the average return, the S&P 500 return. Next, US dollar exposure. We think the US dollar is and will remain the reserve currency of the world for the next 5 years. Yes, there's talks about things like Bitcoin. There's talk about things like the rise of China, the rise of Europe, and so on. Look, Europe, the euro has been around for 20 plus years. It's not replacing the dollar. There's no indication that it is, on path to replace the dollar in any time in the near future, and certainly not in the next 5 years. The other candidates for reserve currency of the world, it basically comes down to the yuan, Chinese currency. Due to the nature of China's relationship with the rest of the world, especially with places like South Africa and the West and so on, I don't think there's any danger that unless China's government and China's policies and China's reputation changes significantly in the next 5 years, that China will be close to replacing the US as a reserve currency of the world. So the US dollar is probably going to remain the reserve currency at the moment, at least for the duration of this particular structure. That gives us more certainty because by being the world's reserve currency, it's likely to be more stable. It's likely to be less volatile than other currencies. It has less chance of a massive devaluation than other currencies. And so you're reducing your risk profile by being in the US dollar. Now, I look at some, if you look at like an analysis by some, South African fund managers and so on, especially when it comes to, looking at, South African investors investing overseas, and they often say the more you have offshore, the higher risk profile is. In the short term, maybe. In the short term, like, oh, do you want to have money that you need to spend next month sitting on dollars? No, probably not. Do you want to have money that you can spend in 10 years' time or 15 years' time sitting in dollars? Well, probably yes. Because in 10 years' time or 5 years' time, it's much more likely that the US dollar will be stronger versus the rand than the opposite way around. The pathway right now looks to be about a 6% per year weakening of the dollar versus the rand. And that has been the case for the last I would say 30 years or so, from about 1994 till now. In that scenario, being in US dollars for a 5-year period is probably a lot safer than being in rands in the 5-year period. Yes, it was possible that in 5 years the rand is slightly weaker against the dollar is slightly weaker against the rand for whatever reason. But there's a much higher chance that the rand basically falls out of bed versus the US dollar falling out of bed. By falling out of bed, I mean weakening significantly. And that safety, I think, is important in the current environment. You never know when the next black swan is going to occur. You never know what's going to be affected by it or not. And in that environment, you want to be in the safest thing you can be. And the US dollar right now is the safest currency. It probably will remain the safest currency, at least for the next 5 years. So what are the risks here? The investment is in US dollars and doesn't account for South African currency movement, positive, negative in the dollar and the rand. So in rand terms, if the dollar does basically get weaker and the rand strengthens over the next 5 years, you could maybe lose money from that point of view. If the index has not fallen by, or has fallen by more than 35%, you may lose some or all of the capital. And that would assume that one of these indices went down to zero. That would be required to lose all the capital. The chance of the Nikkei or the Nasdaq or the Euro Stoxx 50 going down to zero, well, it's possible, but if it does happen, we are living in a very, very different world than we live today. It'll be the greatest financial crisis that we've ever witnessed if any of these indices go down to zero. Okay, makes the Great Depression look like peanuts. You may lose basically the return if we end between 0% down and 35% down. In the case of bankruptcy, a default of the credit provider is obviously a risk. The risk of early settlement of capital, that means you may have decided, I want to tie this money for 5 years. It's possible you get paid out in a year or two because of the fact that we get these multiple autocalls. So you don't know exactly when you get your money back. You obviously know the last time you can get your money back, which is in 5 years, but you may not know when exactly it's going to happen. Is it going to happen in 5 years? It's going to happen in 1 year. And that's obviously a bit of risk in terms of your planning going forward. And obviously, if you are planning going forward, you may not know when exactly you need the money. And it might just be that the money doesn't come out at the time you need it or comes out later than you need it. Okay. How it works. Okay, so let's just look at a little graph here that illustrates how this particular thing works. So here goes. First observation. If all the underlyings are above or at auto trigger level, yes. Early maturity, you get paid out your full capital plus, let's just say this is going to be 12 months down the line, 12%, because you only have been in for 1 year. No. Let's go to the next observation. So observation 2, not there yet. 3, not there yet. 4, yes, it's there. Then what you get paid out the capital plus 4 observations, which is going to be happening in, so observation in year 1, 18 months, 24 months, 30 months. So you're going to get 2.5 times 12%. Okay? Roughly, you're going to get 1% for every month you are invested here. If it happened in, in observation number 6, it's going to be 1 year, 18 months, 24 months, 30 months, 30 months, 36 months, 42 months. So we get a 42% return, okay, for that particular investment. And of course, it happens at the end of the period, you're going to get a 60% return, okay? That's the final one. If at the end of the period, you've never triggered, the underlyings have never got into the target level, but you basically are at a point at which it's above 30%. Okay, the lowest performing one is above being down 30%. Then you get your money back. If it is below the 30% barrier, then you take whatever that loss is below 30%. If it's 36%, you lose 36%. 37%, you lose 37%. But if it's 34%, you get your money back. And here are basically examples of how this would work. Here, these things are positive right, in about 3.5 years. In that scenario, you get your money back in 3.5 years. Okay. Here, 2 are positive after 3.5 years. 1 is not just negative, but below 35%. You lose the performance of that yellow line. Okay, so whatever the 35% plus return is, or 35% negative return is, sorry, whatever that amount is, you lose that. And finally, never positive altogether until the end, you get all that money back. So if it's in between 0 and 35, you get your money back. Above 35, above 0, sorry, at any of those call periods, you get your money back plus basically a 1% for every month that you were invested in. And any one of them is below 35% down, then you lose that percentage. So here goes in terms of the minimum investment amount and fees, etc. Total fees are going to be 3% paid up front, and that's it. The minimum investment amount is $20,000. Okay. So yes, this is about, at the moment, just under 400,000 rands. And the closing date is the 10th of May, 2024, in a few weeks' time. Now, just on the minimum amount, it is $20,000, so you need dollars. So you need to get money out of the country. We will assist you with that. We will take the money out of the country for you if you haven't been able to do it yourself, or you can do it yourself and just deposit it into your offshore account. Either one is good. This structure has to be held offshore in an offshore account. We will create that for you if you don't have one, or you can use one of the ones you have already with us. This structure requires offshore funds, therefore you have to do an offshore transfer. If you want to do an offshore transfer, you need to know basically how to do that transfer. We can assist you with that, as I said. But everyone in South Africa is allowed R1 million a year, discretionary allowance, more than the 400,000 or so that's required as a minimum amount. In addition to that, everybody's allowed to have another 10 million rands if they have that money available, transferred out within the next year or so. Like I said, if you have the money available. So if you're able to show that you have, like, say, 5 million rands in cash in an account somewhere that's showing that you have that money, you get a 5 million rand allowance. You can check for sure as well. All this requires is a tax clearance, which we can assist you with as well. So money must be offshore in an offshore account. If there's a problem, we'll assist you with that. The total fees are 3%, but all the things I talked about, the guarantee, the return, and so on, work off the initial investment you made, not the 3%, or initial investment minus 3%. So you've got 100,000 in this, there's a 3% fee, so the 3,000 comes out. But when you get your guarantee, you get 100,000 rands back. And when you basically get your return, you get the return on that 100,000, not the 100,000 minus the 3%, if that makes sense. And that's it. This was a bit quicker than I thought. It was just a simple little explanation. Do you guys have any questions about what we've just discussed here? If you want to, you can just type in those questions into the Q&A. Second. There's a Q&A box, there's a chat box here. You can type your questions in either of those things, or you can raise your hand and see, and we can see, like, what you're looking at. Okay. I see. Why did you choose these indices? Okay. The indices basically were chosen by looking at what gave us the best return. So we had options like the S&P, we had options like, for instance, the FTSE and so on. We chose the Nikkei, Eurostoxx, and NASDAQ because we think these are some of the better indices out there for this particular kind of product. If you are looking at just a pure play on growth, you would not choose the Eurostoxx 50. It doesn't really perform. But at the same end, over the last few years, it's been remarkably stable as an investment. And therefore, the chance of it returning, to positive and being in a positive territory from the time that we're talking about right now is pretty high. We chose the Nikkei because, first of all, it's been in a bit of a recovery. The second thing is we think that the Japanese market is probably a little bit undervalued at the moment, especially considering some of the things that are happening with the currency, and especially thinking of looking at some of the stuff that we expect to happen going forward from here, in terms of things such as the debts issue that the Japanese have. things such as the rebalancing of the global economy and movement of manufacturing away from China and moving away from Taiwan. The Japanese remain one of those few, I think, countries that can actually step in and take the place of a country like Taiwan, in terms of manufacturing these kind of, incredibly high-end goods, like computer chips. And then we chose the NASDAQ because we think there's an opportunity here, in terms of getting a return that is, reasonably good, because the NASDAQ is exposed to, obviously what's happening with regards to the US economy, but also with regards to what's happening in the rest of the market as well. And the question, I got another follow-up question. Explain the scenario 2 again. Why one of the indices was below 35%? Why do you not choose the weighted average of these three indices as opposed to just one index? So it seems that if one index underperforms, you lose out, whereas a weighted average composite will do better. The reason is that we are in an environment right now where you want to have a higher return. To get that 12% return, you've got to make some sacrifices. The question is the sacrifice is good enough? True. If you had to have a weighted average, you would get a better return than having an individual, also a lower risk profile. Because let's just say once, look at the scenarios, like one index did really well, one index did badly. The bad plus the very good might end up being moderately good. In that scenario, you're making money, despite the fact that one of them is negative. On the other hand, the question arises is, what's the chance of that happening? What's the chance of, like, for instance, the Nikkei or the Euro stocks dramatically underperforming or being negative when, say, another index is up, say, 23% in that period of time? And I think that in the current environment, that's unlikely to happen for one main reason: interest rates. Now, I know we see interest rates basically falling at some point in time, but right now, not happening. What does that mean? We expect interest rates to fall definitely in the next 5 years. We have some pretty high interest rate levels at the moment, but we expect them to fall at some point in the next 5 years. Some people believe that interest rate falls are going to happen this year. Cuts are going to happen this year. Some people say maybe next year. Nobody's saying it's not going to happen in the next 5 years. When interest rates start to be cut, these indices will be positive. If indices are to be cut, you're going to find the Japanese doing very well because a lot of stuff they sell, like cars and so on, benefit a great deal from a lower interest rate. Same thing with the European Union. They would also benefit from lower interest rates. They have raised interest rates like the Americans have. The Japanese have not, but the Americans and the Europeans have raised it. They'll benefit from weaker, lower interest rates as well. At the same time, the NASDAQ is really dependent on, lower interest rates because it's a tech sector. And lower interest rates really, really work well with tech companies because a lot of the growth is in the future. Lower interest rates means the lower discount rate. Therefore, the future valuation is worth relatively more in the current times because interest rates are low. Imagine, for instance, you have an interest of 100%. That means $100 in the future is only worth $50 right now because you put $50 in the bank, 100% return. In the future, that's going to give you 100 rands. Therefore, if you do the reverse, 100 rands in the future is worth 50 rands right now. And that, I think, is why we'd see the NASDAQ doing well. So in the environment that we expect to be happening over the next 5 years, we expect interest rates to be cut. That's going to be really positive with these particular indices. And that is why we chose them together, because we think they're going to move together. Maybe one's going to go up 20%, maybe one goes up 5%, but it's unlikely going to happen that one goes down 10%, the other two go up 30%. Not going to happen, not very likely to happen. Much more likely that maybe one goes up 10, one goes up 20, but they all go up together or they all go down together. That correlation is what we basically are working on. And that correlation results basically in obviously, not getting as much benefit from having the weighted index versus having these three together. But by having the three different ones together, not the weighted one, that worst off thing gives us a higher return, 12% as opposed to maybe another 10%. Okay. Compare this investment with, for instance, gold. Look, I don't mind having some gold in your portfolio. The reason being is that gold is obviously a safe haven investment. The problem with gold is it's not as much a safe haven as you think. It's a slightly safe haven investment, I would put it that way. When people are worried, you buy gold. When people are terrified, you don't buy gold. But what happened to the gold price in COVID? What happened to the gold price in the financial crisis? What happened to the gold price when things get really, really scary? People sell their gold. When things are slightly nervous, gold is good. When things are very nervous, gold is bad. Okay? When things are very good, gold is bad. Gold has a particular range of slightly bad, where it performs. And that is why we don't look at gold as a long-term investment, because long-term, the trend is unlikely to be slightly bad. It's going to be either very good or very bad, or maybe moderately good, but slightly bad is not a very good investment prediction, I think, in the global economy at the moment. Next, Robin asks, please recap the credit risk of the provider on this investment product. Now, I don't have a provider for you at the moment. We know who the providers are giving us the best prices right now, so we know what they're likely to give us. But what's going to happen is when we have the money together, we're going to go back to these guys and say, hey, give us a better price. And that's why I said at least 12%. We're probably going to get above 12% in terms of return, because at that time, what we're going to do is to go back with the actual money in hand and say, now give us a real price for this thing. And at that point in time, the different providers out there could be, BNP Paribas, it could be JP Morgan, it could be Goldman Sachs, it could be a number of different players out there are going to come back and give us return offers on the money we're putting down. We will not look at anybody below investment grade. Investment grade, by the way, is somewhere that's above where South Africa is right now. So if you're willing to put money in a South African bank, these banks, these institutions will have a rating that's higher than any South African institution. Because you can't build stone on top of sand and expect the sand to basically maintain the strength of the stone. You can't build a strong company in South Africa that's dependent on trustworthiness and so on. And the South African government itself is going to be the real weak link here. Okay, the South African government is not creditworthy, so no South African institution is creditworthy. So everything that we're looking at would be at least stronger than any South African bank, and usually by several orders or notches above that. Okay, and so yeah, we are going to take credit risk. It's going to be from a select group of banks, but each of these banks is going to be rated not just higher than a South African bank, but higher than Africa as a country as a whole. Okay, and that's an important factor to put into play as well. But we won't know who these banks are until we do the final bid, because at that point in time, one of them is going to come out with an offer that's better than the others, and we're going to choose that one. We don't know in advance if it's going to be Goldman Sachs or JP Morgan or Citigroup or Morgan Stanley or whoever it may be. But it's going to be one of these banks that, like I said, in like a very highly rated, or BNP Paribas or something like that. And we'll choose the one that gives us the highest return if we accept the level of credit risk. Okay. Any other questions? Okay. So, Steve wants me to explain what's an autocall. Okay. An autocall, if you think about it this way, is imagine there's a rugby game. Okay. But every, like, say, 10-minute period, like, so every 10, 20, 30, 40 minutes, and then 50, 60, and so on until the end at 8 minutes, you take a test to see whether or not your team is winning or not. If your team is winning, you shut down the game and you say, you've won and you get the prize. That's what an autocall is like. Instead of waiting until the end of a structure to see whether or not you basically get the prize, the return, what they do is they look at every period, we call this callable periods, and say, yes or no, yes or no, yes or no. In this particular structure, you have 9 periods where it can be yes or no. At any of those 9 periods, all 3 of the indices are positive, shuts down, and you get 1% return for every 1 month, effectively, that you've had the structure in place. Now, the structure could last 5 years, the structure could last 1 year. That's kind of the range of it, right? It won't be more than 5 years, it won't be less than 1 year. And obviously, people want to have access to the money in the meantime and so on. So that's one of the reasons that we say you've got to have the ability to stay invested for the longer term. But also at the same time, you've got to be understanding that whenever this thing does close, it's going to close. We have no choice in the matter. It's an automatic thing. Obviously, when it does close, and if you are invested, we'll offer you, another product to replace this one here. That's maybe similar or maybe whatever, it's very attractive at that particular point in time. But right now, but understand that these things do close, you just get your money back. And then obviously you can decide to reinvest or to keep that money as well. So that is how an Autocall works. It's basically a case where you're taking a reading every few periods. And at any time when the reading meets a successful answer, the structure closes down, you get paid out your money, and that's it. And like in this case, like I said, imagine it happened on reading number 5. So if you 1 year, 18 months, 24 months, 30 months, 36 months, you get a 36% return. Can you please advise on the tax implications of this investment? Now, here's the thing. We can't give you tax advice. All I can say is that historically, people have been allowed to claim this as capital gains. But we cannot give you tax advice on this particular thing, unfortunately. But look, you have the money at risk. The term was meant to be more than 3 years. It's 5 years. And so according to my normal definitions of you won't be needing to basically buy and sell this thing in less than 5 years. You just have to be kicked out in less than 5 years. So this should technically qualify as capital gains because your capital was at risk. You were not paid an interest rate. You were rather getting a return based on performance, and you were willing to keep this for more than 3 years. You were willing to look at this 5 years. So historically, like I said, people have been able to claim capital gains on these things. But like I said, we are not tax advisors, and therefore we cannot give you tax advice. Okay. Thanks, Robin. Okay, guys. Anyone else? Okay, so like looking to invest, what I suggest you do is give me a ring, viv@randswiss.com, send a message, or info@randswiss.com, up to you guys. And then what we'll do is we'll proceed from there in terms of, what needs to be done. If you have an investment overseas already, you have money overseas, it's really simple. If you don't have these things, we'll have to create them for you and do the transfer, etc. Again, not very difficult. We'll handle the admin if you have any issues. At the end of it, you have no structured product, no product accounts before. You'll get an account created for you. And that account can not just handle this, but it can handle other instruments as well if you went down the line. Not just structured products, but a lot of other, like, shares and so on. We'll help you with the offshore transfer. We'll help you with the tax clearance and whatever else you might need to get that money out of the country. Okay. Okay, guys, I think that's about it. I have no other questions coming through. Anyone else? Last one? No. Okay. Thanks for joining me. I look forward to speaking to you guys again. Hopefully you guys will contact me and then we can maybe proceed with this investment if you think it suits your needs. Thank you.